I started out as an attorney practicing banking regulatory law in Charlotte, North Carolina. I practiced for 10 years, and then I decided, and I love being a lawyer, so because I know there are lawyers in the room, so let me say that I own and love the fact that I am an attorney. But after practicing banking regulatory law for 10 years, I knew I had to atone. And so I quit and moved my family to New York City and went to seminary. And I'm a priest in the Episcopal Church. I received my doctorate at Jewish Theological Seminary and Columbia University in ethics. And the most fun I've ever had in my life was standing in front of my class of entering freshman seminarians with my collar on and telling them that I was going to teach them ethics and then reveal that I was an attorney. And you could just see the sort of idealism go flushing out of their faces. I worked full-time for the Episcopal Church in New York City for a number of years, and during that got involved with a group of Wall Street financial firms as I led a grant program that was funded by the Lilly Foundation to upgrade and educate nonprofit church institutions around investment management. And in 1995, as a result of my interactions with leaders at Merrill Lynch, in that program, I was asked to come to Merrill Lynch and build and sustain, support, manage their charitable and nonprofit services division nationally, which I did for 10 years. I then left Merrill and went and became the Executive Vice President, Provost, Dean, and Chief Academic Officer at the American College in Bryn Mawr, Pennsylvania. And then I left there and went to Wachovia Bank to revitalize their charitable and institutional foundation services group, managed through the Wells Fargo transition, acquisition, merger, depending on who's talking about it, and then went to Foundation Source 8 months ago. And so I tell you all that because I think my life journey, my professional journey, has been one that has wobbled back and forth between what I would call the concentrated for-profit sector, banks and brokerage firms, and the concentrated nonprofit sector, churches and educational institutions. And I finally was led to understand that the best place for me to have comfort was in a place where I could talk about money and purpose and mission. And that's why I think I've ended up in the space that I'm in, which is the intersection of finance and philanthropy. And so as we talk this morning, I think what perspective I bring to the table is that I have spent time both in the nonprofit sector and in the for-profit financial services sector through the evolution of this conversation that Stephen was talking about this morning. And I have seen ignorance in the financial institutions of these issues evolving into hesitant acceptance but resistance, and now I would say evolving even further into embracing these issues and trying to support and develop processes that support these issues among high net worth, ultra high net worth families and philanthropic institutions. So that's for me. Matthew, if you'll introduce yourselves, you can press start, I think, and all right. And here's
The only thing I can imagine he needed to atone for was probably writing the decision that eliminated Glass-Steagall. I'm just guessing. So I'm not going to go into any detail about my background. It's somewhat irrelevant, I think, for this conversation here. Very briefly, however, I'm a co-founder of a multifamily office based on the West Coast. We have about 65 families worldwide, manage just under $2 billion in assets, and a growing expertise in impact investing. I was invited to talk today because I'm an investor. I'm definitely a capitalist. And I think that needs to be said up front, because as I run through my bullet points here, and I'm going to talk in bullet points because I only have 5 minutes, so that way if I run out of time, you won't know that I'm just skipping bullet points. I was at a meeting last week at the State Department, focused on trying to create this global impact economy. And I realized, listening to a lot of the speakers and a lot of the participants there, that I am an impact advocate, not an impact evangelist. And I think that differentiates me somewhat from a lot of the people in this space. And the reason for that is that we look at impact decisions from the perspective of portfolio construction, and portfolio construction is in turn driven by pretty robust, really detailed lifetime discounted cash flow models for our clients, which in turn leads to the fairly obvious observation that asset allocation drives all portfolio decisions. So coming from that perspective, we work with 6 asset classes: cash and cash equivalents, long-only public equity, domestic, international, we just conflate them, private debt, public debt, alternative investments, private equity, and real assets. And what I'm going to do is kind of walk through the experience that we have had over the last 7 years investing in this space and try to just debunk some of the bullet points that tend to float around, all right? So I'm going to have to refer to my notes here so I don't forget them, so I apologize for looking down. So first of all, investing with an impact lens is easy. It is not, but we don't think that any investing is easy. Any methodology that purports to extract alpha from a portfolio by reducing the list of available options in a portfolio is by definition going to introduce some level of tracking error. And as soon as you do that, you are introducing risk, like full stop. Adding the complexity of seeking social and environmental value within the context of pursuing financial return, it's hard. It's really hard to do. Impact requires that one abandons the pursuit of financial return. I love that one because that's just so stupid. Despite what many practitioners will tell you, and those are the people who are rejectionists, saving the world is not, however, a intrinsically profitable enterprise. It is just as challenging to launch, grow, and operate a company which does institutional scale energy efficiency retrofits as it is to launch, grow, and operate an automobile company. Investing is hard, and there are innumerable ways to lose money, and I'm seeing lots of nods around the room, so I think I've got a lot of professional investors in here. Having said that, of course, we don't think that impact investing is necessarily any harder than conventional investing. Yes, the opportunity set is smaller, but it is growing. But interestingly to us, the number of, I'm going to use a loaded term here, sophisticated players in the space is still pretty small. And as a result, we've seen this dynamic manifest itself in really attractive valuations. Like when you come to a company that's really interesting and there's not a lot of people chasing the deal, valuations are good. So from that perspective, and I know Michael's going to stand up and cheer when I say this, we think there's a lot of very compelling investment opportunities in the impact space that aren't necessarily linked to social and environmental return, but just simply offer that as a derivative from the primary investment thesis. Social and environmental impact metrics matter. This gentleman here sort of mentioned that, and Stephen mentioned it earlier. We just don't think they do. I mean, it's great to know that, but we have seen so many people just wrap themselves around the axle trying to quantify the social impact of their investments. And we think that trying to do that sort of leads to Voltaire's dictum that perfect is the enemy of good. Man, that's exactly right. If you are prohibiting yourself from making sensible investments because you can't measure the social and environmental impact of the investment itself, then you won't do the investment. That doesn't make any sense. As Stephen said, get comfortable with a little bit of ambiguity there, and you will be able, oh, I got 10 seconds, okay. Impact investing is an asset class. We do not think so. Investments with impact can be found in every asset class, and that's primarily around characterizing investments through risk, liquidity, and return assumptions, and that determines what asset class they are, not whether or not it's an impact investment. We believe really, really strongly in that. Terminology is fungible. No, it's not. Just to point to 2 obvious ones that have already come up in conversation today. There's a distinction between impact investing and investing in social enterprises. I'll stop there because it's a bullet point. Impact companies can survive without survive without focusing on profits. I don't agree with that. If a company is not profitable, it is not sustainable. Period. What you do with your profits determines how far on that social enterprise continuum you are. Okay, I've gone 47 seconds overboard, so I'm just going to stop right there. Okay. That's fine. I'll turn it over because I got a bunch more stuff here, but I'm sure it'll come up during questions. Okay.
Hi, I'm Genia Topple. I'm the former executive director of the Rockdale Foundation and Rockdale Fund for Social Investment. And I'm going to give some examples today about how a traditional foundation started taking its first steps towards mission-related investing. These foundations are family foundations with assets of about 23 million. They were started in 1996, and our primary programmatic focus areas were microfinance and education. So in 2003, we began educating our board about the importance of mission-related investing. We had heard about it from the Heron Foundation in New York, which is definitely a trailblazer foundation in this area. And we wanted to do this because we've really learned that microfinance is a development tool that should be fueled by investment capital instead of grant capital. And is everyone familiar with microfinance? Okay. If not, I'll give you a tutorial after the speech. And also, we wanted to be a good example of how foundations can employ their corpus for mission-related impact by applying the same discipline as they would a fiduciary investment. So, after 2 years of educating, in 2005, the board voted on a new investment policy that would allow the foundation to invest 15% of its assets in mission-related investments. And the investments had to meet 4 criteria. One, they had to be, and I say relative, because most mission-related investment activities are going to have, you can't find any securitized, many securitized mission-related investment opportunities. They had to be liquid, so short to medium term, in order to not get ourselves locked into rates if a bull market should happen. And we would try to achieve a return comparable to what we could make in a money market. So we ended up making 4 investments that year, and they were all in microfinance debt funds. So these debt funds would make loans to microfinance institutions in developing countries. And then the microfinance institutions would take the capital and make small loans to entrepreneurs. I'll just tell you a little bit about the funds. We invested in the Deutsche Bank Microfinance Development Fund at a rate of 1%, and the Capital for Communities Fund at a rate of 4%, the Action Bridge Fund at a rate of 2.875%, and the Calvert Foundation Fund at a rate of 2%. And we estimated that the average yield would equal what we were earning in the money market at the time. So some of the barriers to mission-related investing, as Matthew mentioned, the opportunities are few. Especially at the time, there weren't many microfinance funds, but they were slowly emerging, and there wasn't a lot focused on international or education, so we were pretty limited in our opportunities. Educating the board was very difficult because they felt responsible. They wanted to be good stewards of the money, and convincing them that mission-related investing was equally as effective as grant making was a tough one, because they didn't want to make money off the backs of the poor. They wanted to help build better lives for the poor. So it took lots of convincing, and we actually brought in some experts who had done mission-related investings through their foundations to help convince and educate the board further. And information. At the time, there were the Ford Foundation and the Heron Foundation were the primary trailblazers in this area. And now there are many other organizations like More for Mission and the PRM Makers Network that really collect information about opportunities. They bring in people interested in the space who can share expertise, and they have wonderful websites that provide other resources to read. Overall, it was a great experience. Every investment we made was repaid, and we actually renewed 2 of the investments, the ones who had the highest yields, because we started to realize the potential of mission-related investing, that we really could make money and improve lives at the same time. And so much so that the founder of the Rockdale Foundation decided to launch the Gray Matters Capital Foundation, which Sam is going to talk about now, which ended up investing over 60% of its corpus in mission-related investments.